Picture this. You just sold $47,000 of stock, pure profit, and the IRS sends you a federal tax bill for zero. Not a typo, not a loophole, not some offshore scheme. This is written directly into the U.S. tax code, and almost nobody under 40 has any idea it exists. By the end of this video, you'll understand exactly how people as young as 38 use something called the 0% bracket to cash out an entire year of living expenses from their portfolio without owing a single dollar in federal income tax. Let's break it down. You probably already know how regular income tax works. You earn a paycheck. The government takes 10, 12, 22, maybe 24% depending on how much you make. That's the system for ordinary income. Wages, salary, bonuses, short-term stock flips. But here's what most people completely miss. There is an entirely separate tax system for long-term investments, and it has its own brackets. 3 brackets: 0%, 15%, 20%. Read that first one again: 0%. For 2024, if you're a single filer and your total taxable income for the year sits under $47,025, every single dollar of long-term capital gains you realize falls into that 0% bracket. Married filing jointly? That number jumps to $94,050. So let me paint a very real picture. You're 38. You've been investing since you were 25. 13 years of consistent buying. You've built up a solid portfolio. You want to take a gap year. Or maybe you quietly retired early. No W-2 job, no salary coming in. Just a little bit of interest from a savings account. Your taxable income for the year is basically zero. This is where it gets really fun. You open your brokerage account. You see shares of an S&P 500 index fund you bought 10 years ago for $20,000. Today, those same shares are worth $65,000. You hit sell. Your gain is $45,000. You held these shares for way more than a year, so it qualifies as a long-term capital gain. Now, since you have no other income, that $45,000 of gain is your only taxable income for the year. $45,000 is under the $47,025 threshold. 0% bracket. Federal tax owed, 0. You just pulled out $45,000 of pure profit from the stock market, and the federal government basically said, cool, nice year, carry on. Now I know what some of you are thinking. There's got to be a catch. So let's talk about the fine print, because there are a few things you absolutely need to get right. Rule number 1. The shares must be held for more than 1 year. If you buy a stock in March and sell it in November of the same year, that is a short-term gain. Short-term gains get taxed as ordinary income. No 0% bracket for you. The IRS treats it exactly like a paycheck. Hold for at least 1 year and 1 day. That is what unlocks the long-term capital gains rates. Rule number 2. This is about taxable income, not gross income. There's a difference. If you have a part-time job earning $30,000 and you also sell $45,000 in stock gains, your total taxable income is $75,000. You're now above the threshold. A chunk of those gains slips into the 15% bracket. The strategy falls apart. This works best when your other sources of income for the year are low. That's what makes it so powerful for early retirees, people taking a sabbatical, or someone between jobs. Rule number 3, and this one is actually a bonus. Do not forget about the standard deduction. For 2024, the standard deduction for a single filer is $14,600. This reduces your taxable income even further, which means your actual tax-free ceiling is even higher than $47,000. Some people calculate their total tax-free ceiling at over $61,000 when you stack the standard deduction on top of the 0% bracket. So the real number could be closer to $61,000 of total capital gains that you walk away with paying 0 federal tax. But here is where I need you to be careful. State taxes are a completely different story. The 0% bracket is a federal rule. Your state might still want to cut. California, for example, does not have a 0% capital gains rate. They tax it as ordinary income. So depending on where you live, you might still owe something at the state level, even if your federal bill is 0. Also, if you're getting health insurance through the Affordable Care Act and receiving subsidies, realizing a large capital gain bumps up your income for the year, which could reduce or eliminate that subsidy. There are ripple effects to watch for. This is not a set-it-and-forget-it move. You want to run the numbers for your specific situation or talk to a tax professional who understands investment income. Now let's zoom out, because the real power of this strategy is not about one single year. It is about repeating it, year after year after year. Think about someone in their late 30s or early 40s who has retired early. They have decades before they need to touch retirement accounts. They have a taxable brokerage account loaded with index funds they've been buying for 15 years. Every single year, they sell just enough long-term holdings to stay under the threshold. $40-something thousand of gains, zero federal tax. They live on that money, or they reinvest it. Or they use it to cover living expenses while simultaneously doing Roth conversions in their traditional IRA, which is a whole other powerful strategy. This is what the financial independence community calls a tax bridge. It's how you access your investment money before age 59 and a half without the 10% early withdrawal penalty and without unnecessary taxes eating away at your returns. And honestly, it is one of the most underused strategies among regular, everyday investors. Not because it's complicated, but because literally nobody teaches it. You don't learn this in high school. You don't learn it in college. Most employers won't mention it during onboarding. Even a lot of financial advisors focus heavily on the accumulation phase, on helping you save and invest. But far fewer talk about how to efficiently draw down what you've built. But if you're someone who's been diligently putting money into a brokerage account for years, you are sitting on a potential tax-free pipeline. And every calendar year that goes by where you don't use this 0% bracket is a year that benefit is gone forever. It does not roll over. It does not accumulate. It resets every January 1st, use it or lose it. So here's the big takeaway. If you ever plan to sell investments to fund your lifestyle, whether that's at 38, 45, or 60, understanding where the 0% bracket sits changes the entire math of your retirement. The people who retire in their 30s and 40s with shockingly low tax bills are not geniuses. They are not lucky. They simply found the rules and used them to their advantage. The tax code is not just a list of punishments and penalties. It is also a list of opportunities. And the 0% long-term capital gains bracket might be the single biggest one hiding in plain sight. If this was helpful, there's more on the channel. Subscribe if you want to keep learning strategies that actually move the needle on your financial independence. And remember, the best time to learn how taxes work is before you need to use them, not after.